Most people think the biggest advantage in financial markets is intelligence. Some think it's discipline, others believe it's access to better tools or faster data. But there's one advantage that quietly outperforms all of them, and it's not available to you. It's proximity to power. Since the passage of the Stock Act in 2012, members of Congress were technically prohibited from trading on non-public information, but in practice, something very different has happened. Not only have members of Congress continued to trade actively, but over the past decade, many of them, especially Nancy Pelosi, have consistently outperformed the S&P 500, and in some cases, even outperformed Warren Buffett's Berkshire Hathaway. And what makes this more interesting is when they buy. Even as markets hit fresh all-time highs in 2025, even as valuations stretch, even as retail investors hesitate, members of Congress are still buying. So today, we're going to do something very simple, but, also very revealing. We're going to look at 3 stocks that members of Congress have been buying recently, and more importantly, why these stocks may matter in a much bigger picture. 2 of these stocks are long-term dividend growth compounders. One of them is a high-yield income play that, honestly, most investors have written off. And the first stock on the list is one that perfectly represents how narratives, not fundamentals, move markets. Alphabet, ticker GOOG, Google. It is a stock that has been talked about endlessly over the last year, and for good reason. At the beginning of this cycle, Alphabet represented one of the clearest disconnects between price and fundamentals we've seen in mega-cap tech in years. And members of Congress noticed. In 2025 alone, Alphabet became one of the best-performing stocks in the entire S&P 500, up roughly 63% year-to-date. Zoom out just 6 months, and the stock surged nearly 88%. This was the best-performing member of the so-called Magnificent Seven during that stretch. But here's where it gets interesting. If you overlay Alphabet's revenue growth with its share price between 2023 and mid-2025, you'll notice something unusual. Revenues continued to grow steadily, but the stock price lagged badly. That disconnect wasn't random. So, the market narrative was simple. Artificial intelligence was going to destroy Google's moat. Search was supposed to die. Advertising was supposed to collapse. Large language models were supposed to, disintermediate Google entirely. But while investors debated hypotheticals, the fundamentals just kept speaking. Alphabet's revenue growth never slowed to levels that would justify panic. And when earnings reports started rolling in, reality began to override the story. Subscription platforms and devices were growing over 20% year over year. YouTube advertising was growing at, mid-teens rates. But the most important data point, the one everyone was watching, was Google search revenue. Search revenue grew 15% year over year. I mean, a business that's supposedly dying doesn't grow at 15%. And that's when the narrative snapped. As earnings beats stacked up and margins held firm, the market was forced to reprice Alphabet, not as a company threatened by AI, but as one of the companies leading the AI race. If you look at independent large language model benchmarks, Google's Gemini consistently ranks at or near the top in reasoning, advanced math, and agentic coding. This isn't theory anymore, it's execution. And when execution becomes undeniable, valuation follows. For most of its history, Alphabet traded at a price-to-earnings multiple in the mid-20s. When fear took over, that multiple collapsed to around 17. 17 times earnings for a company growing revenues and earnings at double-digit rates. That was the opportunity. Now that the narrative has flipped, Alphabet trades closer to 30 times earnings, roughly 30.28. And yet, members of Congress are still buying. Why? Because Alphabet's balance sheet gives it a strategic advantage most companies simply don't have. Alphabet recently acquired Intersect, a data center energy provider, for roughly $4.75 billion. The goal is straightforward: secure long-term power capacity to scale AI and cloud infrastructure. This deal was funded with cash. That matters. For most of its life, Alphabet operated in a net cash position, meaning it had more cash than debt. While that has shifted slightly in recent years, the net debt remains modest and manageable, especially given the scale of free cash flow the company generates. This isn't financial engineering. This is strategic capital deployment. And now, Alphabet has added another layer of appeal. It has become a dividend growth stock. So the real question isn't whether Alphabet is expensive relative to last year. The question is whether Alphabet can compound earnings at low double-digit rates over the next decade. If earnings grow around 12% annually, and valuation merely holds steady, forward returns still look attractive. Even modest multiple compression would still produce market-level returns before dividends. Congress seems comfortable with that math. The second stock on this list surprised me, because it's not flashy, it's not high growth, and it's not popular. It's Verizon Communications, ticker VZ. Over the past 5 years, Verizon stock is down more than 30%. Over the past year, it's gone essentially nowhere, and in the last 6 months, it's declined another 6%. But at these prices, Verizon offers something rare in today's market, a dividend yield near 7%. And when you look at Congressional trading activity, something jumps out. There has been more buying activity in recent quarters than in the prior few years combined. That deserves attention. Verizon's business model is straightforward. About 75% of revenue comes from wireless services, around 20% comes from broadband and wireline, the remainder comes from enterprise and corporate solutions. The criticism is fair. Revenue growth is slow. Verizon generated roughly $133 billion in revenue in 2020. By 2025, that figure had risen only to around $137 billion. This is not a growth stock, this is an income stock. And, income stocks live or die by one thing: free cash flow. Dividends are not paid from earnings, they are paid from cash. In the first 9 months of 2024, Verizon generated roughly $14.5 billion in free cash flow, while paying out $8.4 billion in dividends. In the first 9 months of 2025, free cash flow rose to nearly $15.8 billion, while dividends rose only modestly to $8.6 billion. That's a sustainable payout ratio. Even more important, Verizon's leverage metrics have improved. Net unsecured debt relative to adjusted EBITDA has trended downward, strengthening the balance sheet. This is exactly what long-term income investors want to see. If you assume just 2% annual dividend growth, roughly in line with expected revenue growth, a dividend discount model suggests Verizon's fair value sits in the low 40s per share. That implies modest capital appreciation on top of a 7% yield. Congress isn't buying Verizon for excitement, they're buying it for predictable cash flow in an inflationary system. The final stock on this list gets almost no attention from mainstream financial media. Brown & Brown, ticker BRO, but congressional buying activity tells a very different story. In the fourth quarter of 2025, Brown & Brown saw no selling and, honestly, the highest level of buying in several years. And when you look at the chart, you immediately see why. Over the past year, Brown & Brown stock is down roughly 21%. Over the past 6 months, it's down nearly 28%. Yet revenue continues to grow. That divergence is where opportunity often hides. Brown & Brown is not a traditional insurer. It doesn't underwrite risk. Instead, it acts as an insurance broker, connecting customers with carriers and earning commissions and fees. About 70% of revenue comes from commissions, 30% comes from fees. This creates a capital-light business model with minimal balance sheet risk and strong operating leverage. As insurance premiums rise over time, Brown & Brown benefits without assuming underwriting exposure. Historically, this model has compounded extremely well. Over the past decade, even after this pullback, the stock is still up more than 400%. Dividend growth tells the same story. In 2009, the company paid less than 4 cents per share in dividends. By 2025, that figure had grown to over 16 cents, more than a fourfold increase. Recently, Brown & Brown completed its largest acquisition ever, purchasing a specialty risk management firm in a $9.8 billion cash and stock deal. This acquisition expands its higher-margin specialty distribution segment and is expected to add roughly $1.7 billion in revenue. While management has slightly tempered forward guidance, even conservative assumptions point to free cash flow growth around 9% annually. Running a discounted cash flow model using that assumption produces a fair value estimate just under $97 per share, more than 20% upside from current levels. At the same time, the stock's valuation multiple has compressed meaningfully. At one point in 2025, Brown & Brown traded above 34 times earnings. Today, it trades closer to 24. That compression, combined with steady fundamentals, is exactly what long-term institutional buyers look for, and again, Congress is buying. So, these 3 stocks may seem, unrelated on the surface, but they actually share a common theme. They benefit from asset inflation, not wage growth. In a system where debt is quietly eroded through inflation, real assets, cash-flowing businesses and pricing power become the mechanisms through which wealth concentrates. This is how $38 trillion in debt doesn't really get paid off, it gets diluted. And those closest to the system, they understand this better than anyone. So when you see where Congress is allocating capital, you're not just seeing stock picks, you're actually seeing positioning for the structure of the economy itself. That's it for today's breakdown. If you found this analysis valuable, Make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss future deep dives. I'll see you in the next